This LOS is describe the steps in the preparation of direct and indirect cash flow statements, including how cash flows can be computed using income statement and balance sheet data. Okay, the first thing to point out is that when we're talking about the indirect method or the direct method, we're talking about CFO, cash flow from operations, okay? And so the indirect method, we start with net income, and then we add back certain items, non-cash items. We subtract certain non-cash items, and then we look at the changes in the balance sheet items, and that's how we come up with our cash flow from operations, okay? So the important thing to look at is some of the additions that we make, net income plus non-cash items, and some of the subtractions. So of course, depreciation is non-cash, we add it back, amortization, depletion. But here's an important one that students often overlook, and we see a lot of this in the section on the bonds, is it's the amortization of the bond discount. When bonds are sold at a discount, there's an amount there that's sitting on the balance sheet and it's amortized over time. So think about what's happening when you're amortizing a bond discount. The interest expense is more than the coupon payment. So we need to add back the amortization of the discount. We add back non-cash expense to the cash flow, same as depreciation. So down here, if the bond was sold at a premium, think about that. The interest expense is less than the coupon payment. So we need to deduct the amortization of the discount from the cash flow, okay? And you can see that certain other things like the loss on sale of write-down of assets, loss on investments accounted for under the equity method, increase in deferred tax income liability, decrease in non-current operating assets, yes, of course, decrease in assets. Accounts receivable goes down, that's an increase in cash. So now we're looking at the changes in the balance sheet accounts, okay? And for the subtractions, same issue as I mentioned, it's the amortization of the bond premium, the gain on the sale, net income, we have to subtract the gain on the sale. We saw that from the example in the textbook as well in an earlier LOS. Gain on retirement of debt, that's one to, again, this is gain, non-cash gain. Decrease in deferred income tax liability, and again, we look at the changes in the balance sheet items, okay? So the indirect method, start with net income, add back non-cash items, subtract non-cash items, and then look at changes in the balance sheets, and that's how we come up with our cash flow from operations using the indirect method. Direct and indirect methods for reporting cash flow from operating activities. So the preparation of the cash flow statement uses data from both the income statement and the comparative balance sheets. The first step in preparing the cash flow statement is to determine the total cash flows from operating activities. And cash flows from investing activities and from financing activities are identical under either method. So now when we move to the using the direct method, the operating activities using the direct method, we look at the cash received from customers, the cash paid to suppliers, the cash paid to employees, the cash paid for other operating expenses, the cash paid for interest, cash paid for income taxes. So we use info from both the balance sheet and the income statement for our cash calculations. There's some examples which I've shown in the spreadsheet, examples from the book in the previous LOS, and we're going to roll through and look at the mechanics again now in the next few slides. So now we're looking at the direct method, and the first thing that we do is we look at the cash received from customers. This is pretty easy. We look at the revenue less the increase in AR equals the cash received from customers. Now, if the AR went down, we would add that because that would be cash received from the customers to us, okay? So what we need to look at is we look at the AR account, accounts receivable. We get the opening balance from the balance sheet. That's at the beginning of the year or the end of last year. We can get the sales, and these should be credit sales, by the way. So it would be credit sales, debit accounts receivable, okay? If it says cash sales, you don't include it, obviously. It's not accounts receivable. And then the closing balance we also get from the balance sheet. That's for the end of the current year that we're looking at. So therefore, beginning balance plus sales minus closing balance, that's going to give us our X, which is our cash calculations. We're always solving for X. It's opening balance plus our sales minus our collections equals our closing balance, okay? So you can see if we move this over our collections and make that X, it's going to be opening balance plus sales minus closing balance gives us our X, gives us our cash collections. And that's the way these T accounts always work. 3 items that are given to us, solve for the 4th. Cash paid to suppliers, as I've mentioned in a previous LOS, a little bit harder to memorize, but you need to do it. How do you calculate the cash paid to suppliers? We start with our cost of goods sold plus the increase in the inventory. That gives us our purchases, less the increase in accounts payable, and that's the cash paid to suppliers. So again, if inventory went down, that would be a subtraction. And if our accounts payable went down, that would be a plus there as well, okay? And that makes sense because we're buying inventory, and when we debit cost of goods sold, we credit inventory. So we're starting with cost of goods sold plus inventory increases or subtract inventory decreases. That gives us our purchases, less increase in accounts payable, or would be plus decrease in accounts payable, and that's our cash paid to the supplier. So I showed here you need 2 T accounts. Up here we have our inventory account. Again, for our purchases we can solve. We got opening balance plus purchases minus cost of goods sold gives us our closing balance. Okay, so we can solve for X again using information from not only the income statement but also the balance sheet. And on the accounts payable, it's the same thing. The opening balance on accounts payable. Now we're going to move these purchases down, and the closing balance is from the balance sheet as well. So we can figure out our payments. Okay, if our inventory purchases was not exactly given. So you will recall in the previous LOS, we won't go through it all again. I took the example from the CFA text, income statement, balance sheet, and I did put the data into Excel, and so we could look at the calculations for the indirect and the direct cash flows. And for the direct cash flows here, we had our revenue, then we looked at less the increase in AR, and we had our cash collected from customers. So again, we just had to look up. We used the audit toolbar, and we saw that accounts receivable went up. So that's a use of cash. If accounts receivable went down, that would be a source of cash. And that's why down here, we are going to subtract the increase, and therefore we got our cash from the customers. And again, over here on the right-hand side, I had my accounts receivable account, and we have our opening balance. That's just from the balance sheet. We have our sales, which is from the income statement, and we have our closing balance, so we can just solve for X. Opening balance plus the increase to the account sales minus the closing balance, we're going to have our cash collections. And then our cash paid to the suppliers, we had our cost of goods sold, that's from the income statement. Increase in inventory, that was the case. Inventory did go up. I won't slide up and down again to look at it. You can go back and look at that 23-minute video on the cash flows for the other LOS. That gives us our purchases, then the less the increase in accounts payable. If accounts payable went down, we changed the sign on that, and that gave us our cash paid to the suppliers. So I'm not going to go through all that again. That's in another LOS. I recommend you go back and review that if you have not. Again, continuing with the direct method for cash flow from operating activities. Looking at the cash paid to employees is an easy one. We just have to look at the balance sheet. We've got the opening balance for salaries payable, and we have the salaries expense on the income statement. So that would be debit expense, credit the payable, and we have the closing balance. So for the wages paid, we're just solving for X again, which would be opening balance plus salaries expense minus the closing balance, and we'll have our wages paid. For cash paid for other operating activities, we'd have to look at those other operating activities account, less the decrease in prepaid, less increase in other accrued liabilities, and we'd have our cash paid for other. Cash paid for interest, we look at the interest expense plus the decrease in the interest payable gives us our cash paid for interest. Again, we can use a combination of the income statement and balance sheet by looking at the interest payable account on the balance sheet and the interest expense on the income statement. So if we look at the interest payable account on the balance sheet, we've got our opening balance at the end of last year, the beginning of this year. We add the interest expense, which would be debit interest expense, credit interest payable, and we have our closing balance. So again, solving for X, opening balance plus interest expense minus the closing balance, will solve for X and we'll have the interest paid. And the technique for cash paid for income taxes is exactly the same. We're going to look at the income tax expense, but it's less the increase in tax payable gives us our cash paid for taxes. But again, we can look at the income statement and balance sheet. Taxes payable is an account on the balance sheet. We look at the opening balance plus the tax expense minus the closing balance, and that's going to solve for how much tax we paid. So let's do a practice problem now to check our understanding. The following is selected data from a company's operations. Net income is $100,000, increase in accounts receivable $12,000, increase in accounts payable $9,000, depreciation and amortization $8,000. The cash flow from operations is closest to A, $89,000, B, $105,000, or C, $111,000. The correct answer here is B. We're going to use the indirect method. It's net income plus depreciation, amortization, less the increase in accounts receivable. If accounts receivable goes down, it's going to be cash into us, correct? We've collected the cash, the receivable went down. In this case, it said increase in accounts receivable, so it's a negative. It's a use of cash. Plus the increase in accounts payable. If accounts payable went down, that would be use of cash. Credit cash, debit accounts payable went down. This here says that it was an increase in accounts payable, so that's a positive. So 100,000 plus 8,000 minus 12,000 plus 9,000, 105. So as you can see, doing a cash flow calculation using the indirect method, it has to be done within 90 seconds. The questions are fairly simple once you practice and get the hang of it. Another practice question to check our understanding. So we've got selected information from a company's comparative statements, income statement and balance sheet. So you can see on the income statement, there's sales revenue minus cost of goods sold, depreciation expense, net income, and then there's some selected balance sheet data as well, current assets, current liabilities, etc. But the question is, the cash collected from customers in 2011 is A, $88,500, B, $96,100, or C, $111,500. Okay, so they're asking you the cash collected from customers. So that's the first insight, that you have to use the direct method, okay? And this is just a set up your T account, given 3 variables, solve for the 4th. So they're giving you all kinds of information here that you don't need at all. And that's typical of the CFA exam as well, because you need to be able to zero in and know exactly what you need. So in this case, we're going to use the AR account, accounts receivable, and we can see that this is the beginning of the year and this is the end of the year. Just make sure that you get your columns right. We can see at the beginning of the year, we had the end of last year, we had accounts receivable of $13,500. Then we had sales revenue, we add that $100,000, and we had a closing balance of $25,000. So as I said, we're just solving for X here with regards to our collections from the customer. So it's going to be opening balance plus sales minus closing balance, which is $13,500 plus $100,000 minus $25,000, and we get the correct answer, which is $88,500, which is A. So that question should be fairly easy. You have to zero in that it's the direct method. I'm going to set up a T account for my accounts receivable, set up my opening balance, my closing balance plus my sales, opening balance plus sales minus closing balance, and I've solved it. That's not a 90-second question, but it could be if you're having to look through all the data and get confused, because they're giving you a lot more numbers there than you actually need. So I like that question. Another practice question: assume US GAAP, generally accepted accounting principles, applies unless otherwise noted. At the end of the year, a company sold equipment for $30,000 cash. The company paid $110,000 for the equipment several years ago and had recorded accumulated depreciation of $70,000 at the time of its sale. All else equal, the equipment sale will result in the company's cash flow from A, investing activities increasing by $30,000, B, investing activities decreasing by $10,000, or C, operating activities being $10,000 less than net income? Okay, that's a good little question. They sold the equipment for $30,000 cash, so investing activities would increase by $30,000. A is right, but the C makes you stop and think a little bit. But let's just read through it. The book value of the equipment at the time of the sale is $110,000 minus $70,000 equals $40,000. The proceeds are $30,000. Therefore, it was a loss of $10,000 as reported on the income statement. The loss reduces net income, but it's a non-cash amount, so it's added back to net income in the calculation of the cash flow from operations. So the operating activities would have been $10,000 more than net income. So C is wrong, okay? A had to be right, therefore. A is right. You just know it's right because you sold a piece of equipment for $30,000. Investing activities definitely increased by $30,000. That's the cash that you received. Therefore, so as I said, therefore cash from operations is higher, not lower. The total amount of the proceeds is the cash inflow from the transaction and is shown as a cash inflow from investing activities. So a nice little question there as well. Another quick practice question. A firm reports sales of 50 million euros for the year ended December 31st, 2009. Its accounts receivable balances were 6 million euros at January 1st, 2009 and 7,500,000 euros at December 31st, 2009. The company's cash collections from sales in euros for 2009 is closest to A, 42,500,000, B, 48,500,000, or C, 51,500,000. By now, hopefully these questions are getting easier. You can see we're just looking at the AR account. Our opening balance was 6 million was given to us. Sales was 50 million given to us, and the closing balance, 7.5 million, was given to us, so we're solving for X. Opening balance plus sales minus X equals our closing balance. X equals the opening balance plus sales minus the closing balance, so we just put it in. 6 million plus 50 million minus 7.5 million, 48,500,000. The correct answer is B. Quite easy now. Two more practice questions to finish this LOS. Assume U.S. GAAP, generally accepted accounting principles, applies unless otherwise noted. An analyst gathers the following information about 3 equipment sales that a company made at the end of the year. So we've got 3 columns: original cost, accumulated depreciation at date of sale, and the sale proceeds. Equipment piece number 1, original cost $200,000, accumulated depreciation at the time of the sale $150,000, sale proceeds $70,000. Equipment piece number 2, original cost $200,000, accumulated depreciation $200,000, sale proceeds $30,000. And equipment 3, original cost $300,000, accumulated depreciation $250,000, sale proceeds $40,000. All else equal for that year, the company's cash flow from operations will most likely be A, the same as net income, B, $40,000 less than net income, or C, $140,000 less than net income. Okay, the correct answer is B. The equipment sale 1 results in a gain of $20,000. So how do we do that? Original costs minus accumulated depreciation gives us our net book value. So we can see that is $50,000, okay? And we received $70,000, so we up $20,000 on that. That's easy to see. Original costs minus accumulated depreciation, we can see we've got a net book value here. So we're up $30,000 on the equipment piece number 2. As I said, I don't even need my calculator. And for equipment piece number 3, $300,000 minus $250, which is $50,000. We a net book value, we received only $40,000, so we had a loss of $10,000. So we can see again, 20 plus 30 minus 10, 40,000. That's to the positive. So it would have been B, 40,000 less than net income, okay? Because the cash flow from operations, that was a gain, okay? That was a gain. And what do? We have to subtract our gains and add our losses, okay? One last practice question for this LOS. Assume U.S. GAAP, generally accepted accounting principles, applies unless otherwise noted. The following information is from a company's 2008 financial statements. So they've got balances as at the year ended. You've got 2007, 2008, retained earnings, accounts receivable, inventory, and accounts payable. So they're giving you some data there. In 2008, the company declared and paid cash dividends of $5 million and recorded depreciation expense in the amount of $25 million. The company's 2008 cash flow from operations in millions is closest to A, 25, B, 30, or C, 35? This is a nice little question to end the LOS on, because you've got to do a couple of little quick sub-calculations within the 90 seconds, and you've got to read through the data and see what you need. So the first thing is you're looking for a cash flow from operations. It's going to use either the direct method or the indirect method. It looks like from the data that they're giving us, it's going to be the indirect method. So the indirect method is going to be net income plus depreciation, and then we're going to look at changes in the balance sheet accounts, correct? If the asset went down, accounts receivable went down, that was a source of cash, a positive. And if our payables went down, for example, that would be a negative. So we have to look at the changes in our balance sheet accounts, which we've seen. Okay, but they're not giving us the net income here. They're giving us retained earnings, and they're giving us dividends. So you have to set up your T account very quickly for your retained earnings. And we have an opening balance of 120, which is here. And we have, so it's going to be plus net income, opening balance plus net income minus dividends, which is 5, is going to give us our closing balance, which is 140, okay? So we have to solve for x. So it's 120 plus x minus 5 equals 140. X equals 140 plus 5 minus 120. 145 minus 120 equals 25, okay? So my net income is 25. Then I'm going to add back my depreciation is 25. So now I'm at 50. So I got to look at my changes in my balance sheet accounts. And accounts receivable went up. So that's a negative cash. Inventory went up. So that's a negative cash. And accounts payable went down, which is also a negative cash because my payable went down. Credit cash, debit accounts payable. And so we have to look at the difference now, 43 and 8. That's a difference of 5 in the accounts receivable, so it's minus 5. 45 to 48, that's a difference of 3. So it's 50 minus 5 minus 3. And then finally, 36 to 29 is a decrease of 7. So 50 minus 5 minus 3 minus 7 gives us 35. The correct answer is C. So a nice little question. Couple of little quick calculations. Basically didn't even need the calculator for that. But the trick there is you had to be quick to be able to calculate your net income. And again, that's using the retained earnings. Opening balance plus net income minus dividends gives us our closing balance. Now I got my net income, add back my depreciation given, look through the difference change in 3 balance sheet accounts, and I've got it. Okay, nice question to end on. And that's the last slide for this LOS. Thank you.